Welcome to Intermediate Accounting 2. Today we are considering cash flow statements, IAS 7. At the end of the day, we should know the scope of IAS 7, some definitions that the standard has provided, the benefits of cash flow, and then the measurements, how to prepare the cash flow, present it. The statement of cash flow is a useful addition to the company's financial statement as a measure of performance. The income statement measures the performance of the organization. At the end of the day, giving us the profit or the loss that the organization has generated over the period under review. In the same vein, cash flow statement also helps measure the performance of the organization. The aim of IAS 7 is to provide information about the entity's ability to generate cash and cash equivalents, as well as indicating the cash needs of the entity. Therefore, provides the historical information about cash and cash equivalents. It classifies cash flow into operating, investing, and financing activities. So at the end of the day, you should know that a statement of cash flow is an integral part of an entity's financial statement. It's just like preparing the other four components of the financial statement, namely the income statement, the balance sheet, statement of changes in equity, and then the notes to the accounts. So all types of entity can provide useful information about cash flows, as the need for cash flow is universal, whatever the nature of the organization's activity is. Therefore, all entities are required by the standard, which is IAS 7, to produce a statement of cash flow. Anon said that revenue is vanity, profit is sanity, but then cash is the reality. You see, for some organizations, creative accounting, they can falsify figures here and there, but I don't think when it comes to cash, you can do that to cash. It is the reality. They can have ways and means of massaging figures to probably create a very big revenue figure, right? And then the profits, there's certain expenses, and they can, adjust them. They can massage them to get a very big profit. But then when it comes to cash, what can you do? It's a reality. You can't say you have more cash. If you don't have, you have to show the it. When auditors come around, they will request for your bank statement, which will show your bank balance as at the reporting date. And then they also do cash count on the reporting date. Every 31st December, auditors go around doing cash counts. So at the end of the day, they will add the cash count, the physical cash that they counted in your office. Internal auditors usually do that. They'll add it to the bank balance. They'll compare it to your cash and bank balance in your financial statement. So that one, you can't really do anything about it. So cash is the reality. So it's trying to tell you the essence of cash flow statement. Cash flow basically is the movement, okay? The movement of cash and cash equivalents in an organization, the inflows and outflows of what? Cash and then cash equivalents. What is cash? It comprises of cash on hand, that's the physical cash you have in hand in the office, and demand deposit. By demand deposit, a typical example is the money you have in your bank account. Demand deposit simply means money that you kept in an institution or with an organization, which you can get at any time. Anytime you want the money, you go there, you get it. That's why the money in your bank account, anytime you go to the bank, you will get your money. So that is demand deposit. We also have cash equivalents. Anytime you hear cash equivalent, what do we mean? They are short-term, highly liquid investment that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Typical example of this is fixed deposits, treasury bills. They are all cash equivalent. They believe that if you need your money, it's easy to get it within 1 week, sometimes within days, you can get it. Although at discounted, it will be discounted, but it wouldn't be so much. It wouldn't really affect the value of their money significantly. So that is cash equivalent. What then is cash flow according to IAS 7? It is the inflow and outflow of cash and cash equivalents. I told you that cash flows statement that IAS 7 classifies cash flow into 3 activities. These activities are the operating activities, investing activities, financing activities. The combination of these 3 types of cash flow leads to the overall movement in cash and cash equivalents. Operating activity is defined as the principal revenue producing activity of an entity and other activities that are not investing or financing. So that is operating activity. When you take KNUST, for instance, the operating activity of KNUST, that's the revenue producing activity of KNUST, is teaching. You see, when we teach, KNUST provide, teaching services to students. Students pay school fees. So school fees is the revenue of KNUST, and that revenue producing activity, the teaching that the lecturers, the entire university provide to what students, right? So your assignment is to look at various institutions and tell me their revenue and then indicate their revenue producing activity as well. So it's your assignment. Kindly research into that. So that's operating activity. So it tells you that the net cash flow from operating activity will represent the net increase or decrease in cash resulting from the operations shown in the income statement in arriving at the operating profit. So that is the operating activities, the cash flow from operating activities. How do you present this in the statement of cash flow? You can either use the direct method or the indirect method to present the cash flow statement. With the direct method, this is the format for the direct method. It starts with a receipt from customers. It is an inflow. That's why we are adding, it's a positive figure. And payment to suppliers. That's an outflow. Money is leaving the organization, so it's an outflow. We also have payment to and on behalf of employees. That's also an outflow. The payments we make to employees are the salaries and allowances we pay to them. The payments we also make on behalf of employees are insurance, pensions, the SNET payment that organizations make, various tier 1, tier 2, and all that, provident fund. All these are payments that the organization will make on behalf of the employee. They are all outflow. That's why you see it in brackets. That's why payment to and on behalf of employees in bracket is an outflow. We also have the other operating cash payment. It's also an outflow. So when you put these things together, you get your cash generated from operations. Then interest paid and tax paid. When you put them together, you subtract from the cash generated from operations and you get your net cash flow or outflow from operating activities. If it's a positive figure, then it's net cash inflow. If it's a negative figure, then it's what? Net cash outflow from operating activities. So this is the direct method of presenting the cash flow from operating activities. Move on to the indirect method. The indirect method also starts from profit from operating activities. And you get this from the income statement, the profit from operating activities. When you look at the format of the income statement, You find it there. So that's the profit you start with whenever you are using the indirect method to prepare the cash flow statement for operating activities. Then you adjust for non-cash items. By adjusting for non-cash items, it simply means that all those non-cash items that you dealt with before arriving at the operating profit, you have to adjust them. Remember, we are preparing cash flow. So we are only interested in what? Cash inflow and cash outflow, the movement of cash. So anything that is not cash related, we are not interested in it. That's why you have to adjust for non-cash items. And the typical example of non-cash items are depreciation. You realize that depreciation does not involve the movement of cash. However, we consider depreciation before we arrive at the operating profit. Depreciation is part of what? Either admin expense or distribution expense or whatsoever. We consider it before deriving the operating profit. Because you consider depreciation, which is a non-cash item, you have to adjust it. So if you subtracted depreciation before arriving at operating profit, this time around you have to add back. Another example of non-cash item is profit or loss on disposal. So if there was profit on disposal, you added it to what? The gross profit. Now you have to go and subtract it. If there was loss on disposal, you subtracted it from gross profit. So now you have to go and then add back what loss on disposal. Amortization. If there was any amortization considered, you have to go and add back amortization. So these are some of the non-cash item that you adjust for. Let me go and then show you the extended format. So this is an extended format. I hope you can see my screen. So with the extended format, you realize that okay. You realize that we start with operating activities. When you're preparing the cash flow, you start with operating activities. So under the operating activity, you start with your operating profits, then you adjust for non-cash item. So the non-cash item, this is how you do it. Add back depreciation, add back loss on disposal. So it goes on and on. You subtract profits on disposal, then again you add back amortization. So any non-cash item, you adjust it here. Then from there, you come to movement in working capital. And here we are interested in the 3 working capital elements, which are inventory, receivables, and then payables. We are interested in these 3, the movement in these 3 working capital components. So let's come back to our Excel sheet. With the movements in working capital, let's take inventory. We have increase or decrease in inventory. Now, if there is an increase in inventory, what's the effect of this on cash flow? What's the effect of this on our cash position when inventory increases? When inventory increases, it means your cash is locked up in that inventory. Inventory is not moving, it's rather increasing. It means your cash is locked up, because if you sell the inventory, you get money. If you're not selling the inventory, your money is locked up in inventory. So the effect of increase in inventory on your cash flow is that it leads to what? A decrease in what? Cash. The effect is that it leads to a decrease in cash. What about decrease in inventory? If inventory is moving, then it means you are selling the inventory, so you are getting cash. So decrease in inventory leads to what? An increase in your cash position. An increase in your cash position. So that is what I've done here. So you realize that the increase in inventory, you put it in bracket, but then a decrease in inventory, you are putting it increase in inventory in bracket because the effect is that effects on cash position is that it reduces your cash. That's why it's in bracket. So it's an outflow. But then the decrease in inventory, the effect of that on your cash is that it increases your cash. So it's an inflow. That is why it's not in brackets. Now let's come to receivables or debtors. An increase in debtors, what's the effects of that on your cash flow? Increase in debtors means your debtors are not paying you. They keep on buying on credit. So what's the effects of that on your cash position? You're not getting money. So it leads to a decrease in your cash position. So increase in debtors, we put it in brackets. It's an outflow, right? Now what about a decrease in debtors or a reduction in receivables? It simply means that your debtors are paying you. That's how come the debt they owe you is reducing. So if they are paying you, you are receiving money, right? When that happens, it's an inflow because the effects on your cash position is that it increases your cash position. Now let us look at payables. Payables are your creditors, those people you have purchased on credit from. So if payables increases, what's the effect of that on your cash flow? If it increases, it means you are not paying them, so your cash is increasing. So that is it. But what about payables reducing? When payable is reducing, it means you are paying your debt. So that's why the payable figure in your books is reducing. So if you are paying your debt, then it means that your cash position is reducing. So decrease in payables means your cash position is reducing. So we put that one in brackets. So I don't want to, I'm taking you through this exercise because I want you to appreciate it. You don't necessarily have to choose the format. You have to understand it so that in future, when you meet it anywhere, you'll be able to, prepare a cash flow statement. So let's go back to our compressed format. So after the movement in working capital, then this will be the resulting figure, cash generated from operations. Then you come and then subtract your interest paid. Interest paid is an outflow, that's why you put it in bracket. Then income tax paid is an outflow, you put it in bracket. Then you come to your net cash inflow or outflow from operating activities. If it's a positive figure, it means it's an inflow, it will be net cash inflow. But if it's a negative figure, it will be net cash outflow from operating activities. Usually, the direct method is not usually examinable. It's the indirect method that is examinable. Notwithstanding, familiarize yourself with both, formats. You never know. You may meet a direct method in an MCQ question, but in the proper exams, you definitely meet the indirect method. So this is the format. Now let's go to investing activity. Investing activity are the acquisition and disposal of non-current assets and other investment not included in cash and cash equivalent. So basically, when you hear investing activity, think of what? Purchase and sale of non-current asset, basically. And investments in other words, other investments such as purchase of shares in other companies. Granting loans to other organizations and all that. They are all investments, so investing activities. So these are some examples of investing activities. Cash paid for PPE, cash received on the sale of PPE. So cash paid for PPE is an outflow. The first one is an outflow. And then cash received on the sale of PPE. If you are selling PPE, the cash that you receive is also an inflow. And cash paid for investments in loans. When you give loan to an organization or to somebody, maybe to management and all that, when you give loans to them, it's an outflow. And then cash received from the sale of investments or loan repayments. If, those investments, you are selling it, let's say you invested in share capital in an organization, and if you are selling your shares in that organization, the money that you receive is an inflow. And then loan repayment, probably the loan that you granted to an organization or to some management members, if they are repaying you, is an inflow. All these are investing activities. The interest you receive on your investment, such as loans, you grant a loan to an organization or to anyone, the person pays you interest. The interest received is an inflow, it's under what investing activity. And dividend you also receive on your investment. Supposing you invested in what? The shares of an organization. The dividend you receive on that investment is also what? An inflow. So these are some examples of investing activities. So this is how you present it. So you write investing activity right after the net cash inflow or outflow from operating activity. You continue with investing activity. And then you list the various items. Purchase of PPE, which is an outflow, you put it in brackets. Proceeds from sale of PPE, an inflow you add. Interest received on investment, an inflow you add. Dividend received on investment, an inflow you add. So all those that applies to the question you're solving, you bring them and then you compute for the net cash inflow or outflow from investing activity. If it's an inflow, it will be a positive figure, and if it's an outflow, it will be a negative figure. So let's go to the extended format. You realize that after the cash inflow or outflow from operating activity, you write investing activity, and then you continue. You bring the various investing activities. Then you also find the total for the investing activity, which will be the net cash outflow or inflow from investing activity. Now let's come to our financing activity. They are activities that result in changes in the size and composition of the equity capital and borrowings of an entity. So it's basically a change in the capital structure of an organization. Investing activity basically looks at a change in the capital structure of an organization or movement in the capital structure of an organization. And you know from company that capital structure of a company is made up of what? Equity and what? Debt. The movement in the equity and the movement in what? The debt. Of course, movement that involves what? Cash. Remember, this is cash flow. We are interested in the cash movement, the movement of cash. So let's look at some items, some financing activities. Receipts from issuing shares. You want to issue shares for cash. The money that you receive is an inflow. And then receipts from issuing debenture, loan note, or bonds. When you issue those security items, the monies that you receive is an inflow under financing activity. Then receive from other long-term and short-term borrowings. All the monies you receive from these things are what? In financing activities, and this is also an inflow. Repayment of amount borrowed other than overdraft. So when you borrow money from an individual or an entity, and you are now repaying, that repayment is a financing activity and it's an outflow. Then the capital element of finance lease rental payment is also what? A financing activity and it's an outflow. Payment to acquire or redeem equity shares. They are all financing activity. This is also an outflow. So this is how the format will look like. Proceeds from issuance of share capital is an inflow, so we add. Proceeds from long-term borrowing is an inflow, we add. Then interest paid on loans is an outflow, we subtract. Dividend paid to shareholders is also an outflow, so we subtract. At the end of the day, for any question you are solving, just bring all the financing activities that's applicable to that question. If it's an inflow, we add. If it's an outflow, we subtract. And at the end of the day, you compute for the net cash inflow or outflow from financing activity. If it's a positive figure, it's an inflow. And if it's a negative figure, it will be an outflow. You realize that the interest paid and dividend paid is in red ink. The reason is that the standard IAS 7 permits you to treat these two items under operating activity as well. Dividend paid, you can treat it under operating activity. Interest paid, you can also treat it under operating activity. Although it's a financing activity, it is allowed. The standard permits preparers to treat these two items under operating activity. However, if you decide to treat them under operating activities, you have to stick to that. You have to be consistent with that. As an organization, you have to be consistent with that. We realized that when we were treating the operating activity, the interest paid was there and it was in red ink. So interest paid and dividend paid, you can bring them here. However, if you bring them here, you don't have to bring them under financing activity again. If you treat them under operating activities, they wouldn't come here under financing activity, but you should stick to one. That's what the standard says. So whenever you are solving a question, you decide where to treat these two, but that should be your style. Now, cash and cash equivalents. They are not held for investment or other long-term purposes. They are held to meet short-term cash commitment. Now, when I mention cash and cash equivalents, you know them. A cash comprised of what? Cash on hand, and then the demand deposits or bank, a cash at bank. And then cash and cash equivalent also consists of what? Highly liquid short-term investment. An example is treasury bill and then the fixed deposits. All these things, cash and then cash equivalent. We are telling you that they are held for investment or other long-term purposes. They are not held for investment or other long-term purposes. They are held to meet short-term cash commitments. The maturity date is usually within 3 months of its acquisition when it comes to the cash equivalent especially. And note that cash and cash equivalents include bank overdrafts. Anytime you are solving a question, bank overdraft is cash and cash equivalent. Take note of that. So in conclusion, statement of cash flow is a primary accounting statement. It is as important as statement of financial position and statement of comprehensive income. It's a common exam question, so it is essential for you to familiarize yourself with it. In as much as you are very familiar with the preparation of income statements, you are very familiar with the statements of financial position, and now statement of changes in equity, you should in the same vein be familiar with cash flow statement, because it's also a component of the financial statement and it's a typical exam question. So at this point, I will solve questions. So let me take you back to the formats and then look at the financing activity. So you write your financing activity, then issue of share, which is an inflow, so we add, and share premium. That's if you issue share at a premium. You can issue share at a discount or at a premium. In other jurisdiction, this is not applicable to Ghana. In other jurisdiction, because the shares are carried at their par value, anytime there is issue of share, they issue it at a discount or at a premium. If you issue it at a discount, then it means that the price that you are taking on the issue of share is less than the fixed price of the share. But then if you issue it at a premium, then it means that the price that you are taking for the if you issue it at a premium, then it means that the price that you are taking for the share price is what? Higher than what the fixed share price or the par value. But you know that in Ghana, shares are issued at no par value. You don't have any fixed price for shares. But in other jurisdictions, they have. That's why they always get a discount or a premium on the issue of share. So if you got a premium on the issue of share, it's an inflow, so you add. And if there is a dividend payment, it's an outflow, you subtract. But it's in red ink because we are telling you that you can equally treat it under what? Operating activity. So take note of that. And then the interest paid, that I brought it under operating, it can also come to what? the financing activity. Then loan repayment, if you are repaying your loan, it is a financing activity and it's an outflow. So we treat it as that financing activity as an outflow. So at the end of the day, you add the resulting figure of the three main activities. The resulting figure for operating activity, okay, so I was muted, so let me take you back. So those that I've highlighted, they are the resulting figures from the various activities, the three activities. So for the operating activity, the final answer was cash inflow or outflow from operating activities. And for the investing activity, the final answer was net cash inflow or outflow from investing activity. And for the financing activity, the final answer was net cash inflow or outflow from financing activity. So at the end of the day, you add these three figures from the three activities, you add them. And when you add them, you get this figure, which we call the net increase or decrease in cash and cash equivalents. So let me highlight that one too for you. Maybe let me give it color. This color. We call it what? The net decrease or increase in cash and cash equivalents is the addition of these three items. Is the addition of these three. Then the next thing is to add your cash and cash equivalents at the beginning of the period. The cash and cash equivalents at the beginning of the period. You add it to the net cash, net increase or decrease in cash and cash equivalents. Then when you add these two, you get the closing balance on cash and cash equivalents. Which means that this is the balancing figure. This figure at the end of the day, you're supposed to compare to the closing balance of the cash and cash equivalents in the question. When you compare and it's the same, then it means that the question you solved is balancing. So take note of that. So at this point, I'll go and look for a question for us to solve. And I'll share the question with you. So when you get it, after watching the video, try solving it on your own. So now let me share my screen with you. I've opened one question. Let me open a sheet, another sheet. And then let's go through the question. So we are supposed to prepare cash flow statement for Colby Company. So the trading profit and loss account for the year ended 31st December 2004. We have the sales, raw materials consumed, staff cost, depreciation, loss on disposal of fixed assets, operating profits, interest payable, profits before tax, taxation, dividend, profits retained for the year, then balance brought forward on retained earnings. So we add it to you get the retained earnings at the end of the year. And we also have the balance sheet as at 31st December. You have the comparative figure. You have the figures for 2005 and figures for 2004. Anytime you are solving a cash flow question, you'll be given the comparative figure. This is supposed to help you determine the movement. So because of the movements, we give you the comparative figures for you to know the movement in the various items that we'll be considering. So under your assets, you have fixed assets, carrying assets. You have your equity and your liabilities. You have the share capital, premium, retained earnings, long-term liability. You have loan, current liability. You have trade creditors, taxation, proposed dividend. And we are told that during the period, the company paid 90 Ghana cedis for a new machinery. So we are supposed to prepare the cash flow statements using the indirect method for the operating activities. So let me copy this format and then we take it to let me copy so that we take it to the next sheet. To make it easy for us. So we start with operating profits. Where can we find operating profits? It's in the income statement. So here is operating profits. You start with that one. So the figure is 420. We'll come here, operating profits 420. Adjust for non-cash item. So in the question, what are the non-cash items before the operating profit? Now let me highlight the operating profits. The operating profit is 420. So before this operating profits, what were the non-current assets non-cash items we considered before this operating profit? There is loss on disposal, there is depreciation. The others, we don't have much information about whether it was not involving what cash flow. But at least for the depreciation and then the loss on disposal, we know that it does not involve cash flow. So let's adjust for it. So we add back depreciation. We are lucky in this question we are given. In some questions, you have to look for the depreciation yourself. But here we are given, so you just pick it and then bring it here. So the depreciation figure is 118. And then so that's the depreciation. 118. And then the loss on disposal. The reason why we are adding the depreciation is because before we subtracted, so now we are adding it back. And then the loss on disposal too, before we subtracted, so now we are adding it back. That is also 18. So we bring it here, 18, we are adding it back. Now movement in working capital. We have to find out if there was an increase or decrease in inventory. There was an increase or decrease in debtors, and there was an increase or decrease in payables. So now let us go to the balance sheet. That's where you find these figures. There is the inventory as the stock. So inventory, how will you know if there was an increase or decrease in inventory? Compare the 2 years. We are preparing the cash flow statement for 2005. And for 2005, these are the figures for 2005. Stock is 24. In 2004, stock was 20. So has there been an increase in the inventory from 2004 to 2005? Yes, inventory has increased from 20 to 24. So there is an increase in inventory. And we know that for increase, the effect is cash outflow. So we subtract, right? Let me clean the decrease. So increase in inventory. And please, you have to show working. Let us know how you arrive at your figure. So 24 minus 20. And then the answer will be what? 4 in brackets. It's an outflow. Now let us come here. Receivables. Here is straight debtors. The receivables. Receivables in 2004, it was 58, but in 2005, it is 76. So has there been an increase or a decrease? There has been an increase. The effect is the same as that of the. So let me clean the decrease. Debtors. Then it is from 76 to what? 58 to 76. So we subtract. So 78, 76, sorry, minus 58. So it is 18. So there was an outflow of what? 18. An outflow because data is increasing. Then we look for debtors, trade payable or creditors. Here it is creditors. Look for that figure. So creditor in 2004, creditor was 6, but then in 2005 it is 12. There has been an increase of what? 6. So we'll come here, increase in creditor. So we subtract we delete the decrease. 6. We'll come here, increase in payable. It will lead to an increase in what? Cash flow. So this one we add. So at the end of the day, we have to compute for cash generated from operations by adding all of this. Let me clean this 66. So we got 540 as the cash generated from operations. Now interest paid, and then the tax paid. So let's go and look for the interest paid. So here we have interest payable. Interest payable of 28. So usually, remember here we are looking for cash, the cash that we paid for interest. But usually in the income statement, the figure you see there for most expenses, that's not the actual cash we paid. It's usually what belongs to the period because of the accrual or the matching concept. The matching concept wants you to match the revenue for the period to the expenses for the period. So even if you are unable to pay all of them, you have to make adjustments so that you get the figure that relates to the period. In the same vein, if you made any prepayment, you have to make adjustment so that we get the actual figure that belongs to what? The period. So when you see some expenses in the income statement, don't think that that is the actual cash that was paid. Go to the balance sheet to find out if there was any accrual or prepayment on that very what expenses. So now let us go and find out that of interest. So was there any interest payable under current liability? No. So because there is no interest payable under current liability and there is no interest prepaid under current asset, then it means that what we are seeing in the income statement is what we actually paid. What belongs to the period is what we actually paid. So in that case, we can bring our 28 safely here. So interest paid is what? 28. 28. Now, what about the tax paid? It's the same thing. Let us find out. Let us find out the taxation is 124. Let me highlight this. It's 124. But let us find out if there is any liability or prepayment on tax. When you come here, Karen has said there's nothing on tax. Now when you come to current liability, there is something on tax. Here is a taxation. 2004, we had a tax liability of what, 86, or tax owing of 86. And in 2005, we also had a tax owing of 102. So let us adjust it to find out how much we actually paid for the period. And I have given you a format for all these things. Let's go back to the format, something to guide you. So taxation, because it's a liability, the opening balance, bring it here. You open a T account for it, and because it's a liability, so having a credit balance. And then the balance CD, the closing balance that we were given, will come here because it will be a BD on the opposite side. It will come here. Then what we took to the P&L, taxation 124, the P&L figure, we add it to what the opening balance. So that will come to the right side. That's the tax charge for the year. We add it to the P&L. Then at the end of the day, we try balancing of the accounts. When you balance of the account, you realize that the missing figure will be the cash you actually paid for the period. The cash you actually paid for the period will be the missing figure. So with this adjustment, let us go and then, let me just copy it and then go and do same in our working. So the opening balance here is 86. Opening balance for taxation is 86. We'll come here. 86. And the closing balance is 102. That's the balance CD 102. Then the P&L, the tax charge to the profit and loss is 124. Come here, 124. So now let us balance off. This will be equal to this plus that. Total is 210. We'll come here, 210. Then this one, the cash which you are looking for, the cash figure will be equal to 210 minus 102. So that's 108. So the actual cash we pay for tax is 108. 108. So after this, let us adjust. And please, these are outflows, so let's put it in brackets. You're supposed to subtract because they are outflow. The interest paid is an outflow. Then the tax paid is also an outflow, so we put it in brackets. Good. So now let us find the net. Okay, so we are getting we are getting 404 to be cash inflow from operating activity. It's an inflow because it's a positive figure. That's why you see inflow. So if it were to be a negative figure, it would have been what? Outflow. Now we are done with operating activity. Let's come to investing activity. Investing activity, that's where the purchase and disposal of what? PP, interest, and dividend received on various investments, and then investment that we made in various organizations. So let's find out which of them occurred in this question. In this question, was there any purchase of PPE? We are told here in this additional information that during the period, the company paid 90 cedis for a new machinery. So let's highlight that one. So at least we know that purchase of PPE is what? Purchase of PPE. $90, put it in brackets. Was there any disposal of PPE? Yes, because at least we are told in the income statement that there was a loss on disposal. So how much money did we receive from the disposal item? We don't really have much information as to what was disposed, the value of the assets that was disposed, the money we received and all that. So because we don't have all those information, we have to work for it. So where is the starting point? Working for this. That one to have given you a format which will help you. come to phased assets. Look at the phased asset, the format for phased assets. Realize that in this question, let's come here. The fixed asset, the cost figure is given. And then depreciation, that's the accumulated depreciation. We also have that one. We have all these breakdown. So look at 2004. Fixed asset at the beginning of the period was 1560, but then at the end of the period, we have 1596, right? But we are told at least that there was additional, purchase of what? A machinery for 90. So let us go and open the fixed asset account. So that's the fixed asset account. The opening balance will be this figure, 1560 from 2004. And then the closing balance will be that of the 2005, 1596. So the closing balance will be this, 1596. And at least we know that there was a purchase during the period 90. So that one will come here cash. When you are buying a new machinery, you credit the cash account, you debit what? The asset account. So you credit asset account, the name of cash. The balancing figure would definitely be what? The cost value of the item being disposed, because you already have the closing balance there. So the difference will be the cost value of the item being disposed. So in the same vein, let's copy this and then send it. So fixed asset cost, opening balance is 1560, and then closing balance is 1596, and then the addition, the cash, the additional purchase we made was 90. The first one is 1560. The opening balance 1560. All right, so what will be the balancing figure? So the sum is 1650. 1650. So the difference would be 1650 minus 1596, which will be 54. So it means that the cost value of the item being disposed is 54. So with this, probably we can go to our disposal accounts. All those, I have a format for you. Let me just copy the disposal account in order not to waste so much time in this video. This is the disposal account. At least we have the cost value, right? 54. What else do we know? We know that the loss on the item being disposed is what? 18. Loss on disposal, 18. We know it from the income statement. So loss is 18. Now we are left with what? The cash, what we are looking for. And then the accumulated depreciation on the item being disposed. Anytime we are disposing of an asset, we have to release the disposal. We have to release the accumulated depreciation so far on the item being disposed. So now let us go and then open provision for depreciation account. That one, so I've given you the format here, which you already know from principles of accounting. So provision for depreciation account, let it come here. We have the opening balance and we have figures on that one also in the balance sheet. That's the depreciation you see here. We've already dealt with the cost, so let me highlight the cost. We've already dealt with it. So we are left with the depreciation. That's the provision for depreciation here. So in 2004, the provision for depreciation was 224. And in 2005, the provision for depreciation was 318. So that's the opening balance and the closing balance. So opening balance is 224. Then the closing balance is 318. And then the P&L, that's the depreciation charge for the year. That was what? 118. The charge for the year is 118. So bring it here, 118. So at the end of the day, the balancing figure will be the release on the disposal. So let me add this one. I get 342, 342. So this will be equal to 342 minus 318. 24. So it means that the accumulated depreciation so far on the asset is 24. So now we are left with the cash. This side is supposed to be 54, and then this is also supposed to be 54. Therefore, the cash will be equal to 24 minus, the cash will be equal to 54 minus 24 minus 18, which is 12. So the cash inflow from what? The disposal of the assets that we are looking for. Look at the workings we have done. The disposal of PP, we have 12. It's an inflow. Is there any receipt, interest received on any investments we made? Not that I am aware of in this question. So because of that, interest received, we will leave it blank. It doesn't apply to this question. So at the end of the day, what will be the net cash inflow or outflow from investing activity? That one will be 78 because it's an outflow. So you see here we've written, thank you. So you see that we've written net cash outflow from investing activity. Now let us come to our financing activity. Our financing activity and see what happened. Let's come to the question. It's basically a movement in what? The capital structure. Movement in capital structure. So let's come to equity and long-term liability. That's what we are interested in. So share. There was an issue of share because in 2004, the share capital was 340, but then in 2005, it is 360. Let me highlight it for you. So there was a movement in share. And please, anytime you see movement in share capital, don't be in a hurry to recognize it in the cash flow statement because there can also be bonus capitalization. There can be bonus capitalization. So when you see an issue of share, find out if there was there is any note talking about bonus capitalization. There is any note talking about bonus capitalization, you don't have to recognize it because remember, this is cash flow. We are interested in cash movement. You know that whenever there is bonus issue or bonus capitalization, it doesn't involve the actual movement of what? Cash. So kindly take note of that. And this one, we don't have any information to that effect, so we take it as what? Movement in cash. Issue of share for cash. So let us come here, issue of shares. So I'm saying that with a share premium too, The share was issued at a premium. So it's also increasing from 24 to 36. So we'll come here. That's also an inflow. Now, dividend. Let's go to the income statement. The dividend. Dividend for this period is 72. Don't be in a hurry to use it. Go to the balance sheet and find out if there is no repayment or owing on dividend. You realize that under current liability, there is proposed dividend and current liability. So that's dividend owing. We have dividend owing at the beginning and at the end of the period. At the beginning was 24 and at the end is 30. So we have to do the adjustments. The same as we did for the interest in the tax. Okay. Balance for the dividend is 24 and the closing balance is 80. Dividend for the period, the income statement is 70. Which is 66. The actual payment you made for dividend was 66. An outflow. If you are paying dividend, it's an outflow. Now, let's go back to the balance sheet. There is loan. The loan item. In 2004, the loan was 500. But then in 2005, it is how much? 2005, the loan is 200. What is happening here? There is repayment of loan. So loan repayment is applicable here. 100 minus 200. That one will be what? 300, an outflow. So let us find the net cash inflow or outflow from a financing activity. At the end of the day, these three figures, we are supposed to add them. Those I've highlighted in yellow, add the three figures, and that will give you the net increase or decrease in cash and cash equivalent. So this is equal to that plus that plus that. That is giving us -8. So there is a net decrease. That's why there is decrease, the net decrease in cash and cash equivalent. So you add your cash and cash equivalent at the beginning of the period. The beginning of this period is what? 1st January 2005 or 31st December 2004. So at the beginning, the cash and cash equivalent is, in this question, what is the cash and cash equivalent? At least we know that cash and cash equivalent includes physical cash, cash on hand, cash at bank, short-term highly liquid investment, and then bank overdraft. So in this question, which of them do we have here? I've seen bank. I've seen bank. That's all I see here. I only see bank. There is no overdraft. There is no short-term highly liquid investment. There's no physical cash. So the only cash and cash equivalent we see here is what bank. So at the beginning of the period, the bank was 56. That's the closing figure for what 2004. The bank was 56, so we added 56. Come here, 56. You add. The balancing figure will be equal to what? Net decrease in cash and cash equivalent plus what? Cash and cash equivalent at the beginning of the period, and that is 48. So this 48 should be equal to the closing balance of cash and cash equivalent. And we are right. Here is it. 48. So at the end of the day, if you want to find out if your cash flow statement is balancing, it is this figure. It should be the same as what? The closing balance of cash and cash equivalent. So that is it. Okay, so let's solve another question. Glorious PLC. Let me share my screen with you. Glorious PLC income statement for the year ended 31st December 2006, and the balance sheet 2005 and 2006 are as follows. So this is the income statement. You have revenue through to retained earnings. Then you have your balance sheet. You have the 2005 figures and then 2006 figures. And then there's additional information. During 2006, the business spent 67 million on additional plant and machinery. There were no other non-current asset acquisition or disposal. There was no share issue cash during the year. The interest payable expense was equal in amount to the cash outflow. You are required to prepare the cash flow statement for Glorious PLC for the year ended 31st December 2006. So this is our tax. Let me copy the format again. This is million. Okay, so what's the operating profits? The operating profit is 196. We'll come here. 196. So what are we adding back? We are told that there was no disposal of assets in the notes to the account. So definitely the adding back of our disposal will go off. It's not applicable here. So what about depreciation? There will definitely be a depreciation. But what's it? Realize that this income statement is compressed. We have gross profits, we have less distribution costs, admin expense, rental income is added. So we don't know the depreciation. It means we have to look for it. We have to look for it. When you come to the balance sheet to the non-current assets, you are given values. You are not told if it's cost or what. And there is no detail on accumulated depreciation in the balance sheet. It is telling you that the figures you see here in the balance sheet for the non-current asset, they are what? Net book value or the carrying value. That's cost minus accumulated depreciation. So let's go and open a T account to look for the depreciation for the year. I've also given you in the format, I've given you fixed assets at net book value, how to go about it. If you are giving fixed assets at net book value, how to go about it. I've given you in the format. I'll try and share this sheet with you. So that's it. Fixed asset at net book value. So what's the opening balance and then the closing balance? This is an asset. So opening balance should be having a debit balance. So we can take the total. So total for 2005 is 635. That's the opening balance, 635. And then the total for 2006, that's the closing balance, 624. That's the balance CD is 624. Now we are looking for disposal, depreciation, but we are told that there is no disposal. So supposing there was disposal, you would have brought the value of the item being disposed here. So there is no disposal. So let me clean it. And was there any addition, a purchase of asset during the period? Let's find out. During 2006, the business spent 67 million on additional plants and machinery. So we purchased a plant for 67 million. So that will be the cash here, 67. So at least with this information, we can find our missing figure, which is the depreciation. This is equal to that plus that. So 702, here is 702. This will be equal to the 702 minus 624. So it means that depreciation for the year is 78. So please, anytime you are giving net book value, the examiner will definitely hide the depreciation from you. This is how you find the depreciation. So the essence of this is that the logic here is the opening balance for the net book value of the assets plus the asset that was acquired. Okay, when you subtract the closing balance from it, the difference will definitely be the depreciation charge for the period. So add back depreciation of 78. Now let's look at the movement in working capital. So this, let me highlight this one. Movement in working capital. Start with the inventory. In 2005, inventory was 41, but in 2006, it's 35. It has decreased. So this time around, there is a decrease in inventory. 41, 35. So this is equal to 41 minus 35. So since there is a decrease in inventory, it represents outflow and inflow. So we add. And the next one, trade receivables, it was 139 and now it has 139, it has increased to 145. So there is an increase in our receivables. This is an outflow. It's an outflow of what, 6. Now payable, what happened to payable? Trade payable. Has also decreased from 54 to 41. So that's an outflow. Outflow of 13. The cash generated from operations will be 261. It's a positive figure. Interest paid and tax paid. Let's go to the income statement. Interest payable. Remember, there was a note telling us that the interest we see here is the same as the cash outflow, so there is no need to adjust for it. Let's go and read that note again, but it's 26. So we are told that the interest payable expense was equal. It was equal in amount to the cash outflow. So we don't need to make any adjustments. It's 26, an outflow, so 26. Then the tax paid. Let's look for it in the income statement first. The tax paid is 36. But do we have any other information on tax? Under current liability, there is corporate taxation. So it means you have to make the adjustments. Let me copy the sheets. The opening balance for tax. We highlight it. Opening balance for tax is 23, and closing balance is 18. 23, 18. Let's look at the tax in the income statement, which is 36. That's P&L. 36. So be equal to plus. The cash paid will be equal to 59 minus 18. It is giving us 41. The tax paid is an outflow, 41. So we have cash inflow from operating activities of 194. Now we come to investing activities. At least we know that there was a purchase of PPE for 67. So we just come here. 67. You know that there was no disposal of PPE, and we are also aware of the fact that there is no other investment. Therefore, the net cash inflow or outflow from investing activity will be the same 67. Now we come to financing activities. Look at the share movement in shares. And what's long-term liability? Equity. Realize that there was a movement. There was a movement in equity from 2005 to 2006. In 2005, there was 200 equity, but in 2006, there was 300. Notwithstanding, we are told here that there was no share issue for cash during the year. There was no share issue for cash during the year. Meanwhile, you realize that the share value has increased. It has increased from 200 to 300. Then that is telling you that that was bonus capitalization. Bonus capitalization, it didn't involve what the actual movement of cash. So this one, we are not interested in it. And share premium, you realize that the share premium account is decreasing. In 2005, it was 40, but in 2006, it is nil. You also realize that the revaluation reserve account is also reducing. In 2005, it was 69, in 6, it was 9. You realize that this bonus capitalization was probably financed from share premium account and the revaluation reserve. Because whenever there is bonus capitalization, it has to be financed from a reserve. And since share premium account and revaluation reserve are reducing, it is telling you that that's where we finance it from. And you realize that the amount is the same. 40 plus 60 will give you 100. Then the share capital increased from 200 to 300. So that is it. And then, so issue of share will not be applicable. The share premium, the movement was what? Non-cash movement. So all these are not applicable. So all of them, we delete them. How about dividend? Was there any payment of dividend? Let dividend paid on share 60. Dividend paid on share is 60. But this 60, let's find out if there was any owing on dividend in the balance sheet. Current liabilities, there is no owing on dividend. Which is telling you that the 60 that you are seeing in the income statement is the same amount we paid during the year. So dividend payment 60. Come here, bracket 60. It's an outflow. What about the loans, non-current liability? Let's find out what happened to non-current liability. Current liability. In 2005, non-current liability was 250. Debenture loan was 250, but in 2006 it is 150. It has reduced, so probably there was repayment. That's why it has reduced. So loan repayment from 250 to 150. The difference is 100, right? To an outflow of 100. Therefore, the net cash outflow from financing activity will be 160, an outflow. What about the net increase or decrease in cash and cash equivalents? That's the addition of these three figures. So here will be equal to this plus this plus that. It's giving you a negative 33. So that's a net decrease in cash and cash equivalent. So you add your cash and cash equivalent at the beginning of the period. Beginning of the period is what? 1st January 2006. At that time, what was the cash and cash equivalent? So first and foremost, ask yourself, what is the cash and cash equivalent component of this question? In this question, I am only seeing bank overdraft. There is no physical cash. There is no money in the bank account. There is no short-term investment. The only cash and cash equivalent is bank overdraft. And what's the bank overdraft at the beginning of the period? It was 56. So overdrafts. So that's also a negative figure, 56. So when you add these two, what do you get? The balancing figure. We are there, 89. So you realize that the closing balance for bank overdraft is 89. That's the balancing figure. Yeah, right. So in exams, when you prepare your cash flow and then the final answer is not equal to the closing balance for cash and cash equivalent, then it means something is wrong somewhere. You have to go and check it again. So here, supposing the cash and cash equivalent, we also had physical cash. You would have added the overdraft figure to what? The cash figure at the beginning of the period. So you add all the cash and cash equivalent items at the beginning of the period. You add all of them, and then you come and add to the net decrease or increase in cash and cash equivalent. Then at the end of the day, the figure you get should be the same as the closing balance for all the cash and cash equivalent. So in any question, if you have more than one cash and cash equivalent, you have to add all of them at the beginning and add all of them at the end. And then that's the figures you'll be using. So kindly take note of that. So at this point, we are done with cash flow. The next time I come again to you, we'll be looking at ratios. Thank you so much for your time. If you have any question, just let me know. You can drop it in the comment section. I'll see it and I'll address it for you. Thank you so much for your time. Bye.